Good morning, everyone. Welcome to this great city, reverse mortgage conversation this morning with myself, Shannon Green from Green Lending. And I also have Alessandra, who will introduce herself.
Hi, good morning. Thank you everyone for joining us. I'm Alessandra. I'm a licensed mortgage agent from Army Mortgages, and I'm very excited to help clear up some misconceptions about reverse mortgages.
We also have here with us Chris, who will join in on the conversation this morning.
Hello, my name is Christopher Lee. I'm with ShaCole Brokerage, and I'm happy to be here today. I'm happy to just give some more light on this topic because it's one that's always kind of swept under the rug out of fear and stuff like that. So happy to be here today.
Thank you, Alex. Thank you, Chris. Also, I just want to introduce a special guest, Susie from Home Equity Bank. I thought it was very fitting for her to join us since she is the expert who also assists us whenever we need any help in the industry. Susie, you just want to say good morning before we get into the conversation?
Absolutely. Thanks, Shannon. Good morning, everyone. I'm Susie Fernandez-Cerruta, and I'm a business development manager with Home Equity Bank. And I am here to let everyone know and help you guys and support you in trying to help people understand the benefits of reverse mortgage. Thank you.
Thank you, Susie. So just to start the conversation off this morning, what the three of us want to do, and by all means, everybody else on the call can jump in. We're just going to start off with some misconceptions or things that we just hear in the industry from other brokers, financial advisors, or just our clients ourselves. And we'll just take a few minutes starting with that. So one thing I always hear is, oh, I don't own my home. And just feel, Alex, Chris, just jump in with your sayings as we go along.
I was going to say one that I hear often is, no, they're going to take my house and then I'm going to have no equity left. That's not true, thankfully.
Or the one I got often is, well, if I have to take this out, I'm too old to have a mortgage now. You know what I mean? Like, there's too much, money to be handling at my age. I didn't want to have a mortgage. I wanted to have my house paid off, my affairs in order. This is like not where I want to be in my life right now.
Oh, this is a scam because I don't have to make monthly payments. This doesn't make any sense.
Another one that I hear often is, well, what will my kids think when I tell them?
Mm-hmm.
It's not their finances.
Catherine, I see you laughing at. Just for anybody on the call, have you guys ever heard anything bad about a reverse mortgage, or what are some of the things that you actually hear?
Well, I must admit, I have an elderly mother who had a reverse mortgage with home equity. Her and my brother lived together, and so I wasn't privy to any of it until I had to be. And then it was like, okay, now what happens, right? Because she moved out of the house. And so there was a lot of things that I had no idea. And I probably still don't have the whole picture. That's why I kind of wanted to come and answer some of those questions that aren't worth asking anymore, but you wonder.
I always think that it's you're willing the house to the mortgage company. That's what I think. You're taking out a reverse mortgage. That means you're willing. You can't pass it on to your kids. It's going to go to the mortgage company.
I can honestly say though, yeah, I was quite surprised. And it's kind of serendipity here. My mom's home sold last September, October, somewhere in there. And the lawyer called us and said there was something to pick up. And after, I guess, all the finances were done and the numbers came in, my mom just got a check for a bit of a balance, but it was wonderful. That was owing to her once all the paperwork was done from the bank. And it was like, wow, that's awesome. Because nobody was expecting it. It was like a windfall for her.
Okay. So I'll go ahead.
Just force of habit. I was just going to jump in. And I think that's one of the misconceptions that we share is, people think all the equity is taken away from the home, which is not. The most that we can actually lend on a property is 55%. And normally 55%, it's up to 55%, goes with the client's age. So even though people think, oh, my equity is gone, not necessarily, because even at a 3 or 4% growth, modestly, the client still continues to build that equity. And they have options. They have options to make interest payments monthly if they'd like. Partial interest payments, they can put percentage like 10% towards the mortgage on an annual basis. So if they're so fixated on the interest continuing to grow, they have options, but there's always something there left for the client and for their family.
Thank you. And just to add to that, Susie, since you brought that up already, so all of the things that Alex, myself, Chris have been saying, they're absolutely not true. It all comes down to, you know, product knowledge and having the right advisor in front of you to actually explain the product and how it works. So a CHIP reverse mortgage, or taking a loan from home equity banks, such as where Susie is the development manager, it is a secured loan that goes against the value of your property. And like she said, you do have the options to make monthly payments or not make payments at all. So you're not willing it to the bank, Ivan. You can actually still, you will be on the title of the property. You own 100% of your home still, and you can still leave your home to your children or whoever you want to through the form of a will.
Yeah, I think it's one of those, and I agree. And to build off of what Shannon said, like it's always very comforting for clients to learn that it doesn't impact the estate planning process, because again, that is something that I hear often as well. And it's like, no, we're not taking away your house. We're taking away the burden that you're carrying, because unfortunately there's still a lot of debt, even in the elderly population. So it's like, we're going to take away that burden, but then we're just going to free this up, and it doesn't impact anything you want to do with your kids afterwards in terms of title.
Yeah, and this product, that's what it's good for. It's not trying to get in the way of things. It's trying to help you. Like, everybody knows at the end of the day, you need income. And sometimes income falls short at that point, or it's that stage in your life. So this product kind of like, okay, you know, here's an arm's reach to your goal, you know, do what you will with the funds that we're going to give you. But at the same time, you know, the responsibility is attached to it. But, you know, it's income at the end of the day that's trying to be helpful for these people.
And when we speak about income, one of the things that I like about the product is that it can actually be used. The equity in your home can actually be used as a monthly income. You know, you have a client who says they want $1,500 a month coming to them as an income. That is something that you can actually set up with the bank, with Home Equity Bank, and they will deposit that $1,500, for example, into your account every month. And that can be in addition to your CPP, so your Canada Pension Plan, or your old age security monthly payments as well. It just all depends on your needs. The product is typically for individuals who are 55 and over. We all find as advisors, usually when you're starting to get to that age level or above, sometimes your income does go down, or you don't have enough income, or your kids no longer want to be on title of the property or something. So
the other important thing is, with the income advantage from CHIP, it's tax-free money. So anybody who takes this equity out, it is not added to their taxable income, because as we know, the older you get, the more fear there is in paying taxes, because you think, oh my gosh, I already have property taxes and all these other bills. If I add that to my taxable income, how much more am I going to have to budget every year for income tax? But thankfully, that is not the case here. So it does not get added to your taxable income.
Can I ask a question then? Would that become, would it, even though it's not taxed, is it incorporated in how much you make? Because I know that old age security, I think is based on how much you make, right? And it's like a top up from the government.
My understanding is that it doesn't, because it's like if you were to refinance your house with a regular mortgage, right? If you take out that money from your equity, you don't have to account for that anywhere, because it was already an asset and you've moved it from one place to another, is my understanding.
It's like taking money out of the bank.
Okay.
It's your money. It's your money, right?
Yeah.
So you're not paying tax on your money again in the bank when you take money out of the bank, right?
That seems
Yeah.
too good. Usually you get caught by stuff like that.
So
That's why
Catherine,
I
Catherine, you are your own bank.
wow. Don't
Yeah.
tell my husband, okay? Yeah.
Thankfully, your equity in your house is not a registered investment.
So you guys are absolutely right. Any funds taken out with a reverse mortgage does not affect your CPP or OAS, anything. It is completely tax-free and does not ever affect any government benefits.
And your CPP can't go down anyways. CPP is something that's based on how much you've paid in over your career. I mean, it's relative to your salary. If you always only made, say, $40,000 a year, you're going to get less than somebody who made $60,000 a year. But then it's also based on how many years you paid in. And so that one is different for everybody. I was reading the other day, the average CPP payment's only around $700 a month. I think it's $717, whereas the maximum benefit's $1,300. And everybody thinks they're going to get the maximum, but go into my CRA for yourself, log in. It'll tell you how much you've put in your whole lifetime, and it'll tell you at age 60, based on what you've paid in so far, you could expect this benefit. At 65, you could expect this benefit. If you deferred age 65, or if you deferred age 70, you could expect this benefit. The old age security is different.
That was the one I was worried about because
so old age security is based on the number of years you've lived in Canada between age 18 and 65. To get the maximum benefit, you have to have lived in Canada for 40 years. So if you moved, to Canada when you were 45, you would only get half the benefit because you'd only been in Canada for 20 years between age 18 and 65.
Can everybody hear me?
Yeah.
Okay.
You do cut out sometimes, Shannon. You'll be talking and then we're all moving and you're
Michael,
frozen.
I missed half of what you said because you were talking like a robot just now. So I don't know what's going on with everybody's internet connection this morning, but we will get through it because that's just what we do. So let's go into some qualifications for the product. Chris, Alex, you okay with that?
I see Ivan has his hand up though, so shall we?
Okay.
This question
I didn't see that.
So I can ask it anytime, but here it is. Where does reverse mortgage fit into the tools that you have available? Like when would you go for a reverse mortgage? You can go for an equity line of credit. You can go for an equity loan. When would you say that this is the tool that you should use?
Okay, so you're absolutely right. It is a tool, and in any toolbox that you have at home, you have specific tools for specific jobs, right? Like you're not going to use your wrench as a hammer. So what's going to happen is when we have a client that comes in, we're going to look at the overall profile because we want to make sure that there isn't another option. Just like with any type of mortgage transaction, it's understanding what the client needs and it's understanding what the client does qualify for and does not qualify for. So for example, when we have someone who's say 80 years old coming in saying, I need to do some renovations to make my home more accessible for me. I need help making my house mobility friendly. And I don't want to take out my money from whatever registered investments I have. What are my other options? So that's an example of like how we kind of look at the overall profile and say, okay, this makes sense to do for these reasons. Because when we look at how mortgages are qualified, we have what's called the stress test, right? So somebody who is in their 80s making maybe the max, if they're lucky, they're getting the max CPP and the max old age security, and they may not have a lot of pension from work, depending on how long they were at that company for, or if that company even had a pension plan. Or if it's something like Stelco and that was completely botched and now these people don't have that pension income coming in, right? So it's like, how do we make this work for them because they're comfortable to stay in the home, they're not ready to move out to a nursing home, and how do we make them happy at home? What is it that we need to do? So that's kind of how you have to look at the bigger picture, right? And make sure that everything fits together because mortgages are like puzzle pieces. There's a bunch of pieces that fit together and you have to see what that larger picture looks like in the end for someone.
And you know, Ivan, nowadays most people want to stay in their home. They don't want to move out. So, and they don't want to downsize. Maybe they just want to right size. But because they've been in their home for like 20, 30 years, this would be something that they would start looking at. So like Alex says, they don't have to go into a long-term care facility, or they don't have to move in with those bratty children that they don't want to. They just want peace at home in a space that they are used to, right? And then when it comes to qualifying, if we can just compare the two, if you're going after a conventional mortgage like with RBC or TD, like Alex says, you have to go through the stress test. We're going to look at your credit. You have to be at a certain score. We're going to look at your income just to make sure you qualify and your service ratios align. And then when it comes to a reverse mortgage, they don't necessarily go through all of those steps. Yes, we do a full application and we take all of the same information, but your qualification does not come down to, oh, what is my credit score 680 or 700? It does not come down to, like Alex mentioned, oh, I need 100,000 income to qualify for my mortgage. It doesn't come down to that. But what it does come down to, one of the main things is that you are 55 years and older, and that the value of your property in order to qualify for the right amount that you will be advanced from the bank. Make sense?
Yeah, and just one more thing further to that, because Ivan, I think you had mentioned a home equity line. When we give someone a home equity line, you have to understand that interest is calculated very differently. So when you have someone who takes an advance on a line of credit, it's compounded daily, basically, right? So if you now have someone who is already stretched, trying to figure out how they can get more money to make ends meet, you're creating another payment for them, which doesn't help solve that problem, right? So while you're trying to, in some cases, lessen that financial burden, they're just robbing Peter to pay Paul, right? It's not solving that problem at the end of the day. And it's lines of credit are variable. So anytime prime goes up, that payment now goes up. So yes, it comes down, but it also goes up. And it's, can this client manage that fluctuation on a fixed pension income?
And also you mentioned financial burden, since considering we are bringing down a lot of their burden by removing the monthly payments for them, there are other things that they do have to upkeep as well, which would be paying their property taxes and ensuring that they do have home insurance on the property. Those home insurance has to be maintained on the property at all times in order to maintain and keep the mortgage, right?
I just wanted to mention something as well. Is that okay?
Yes, go ahead.
Yeah. Ivan, I know you mentioned like, when do you introduce this, or is this when would you basically offer this to a client? I think sometimes clients think that this is something permanent. When they get into a reverse mortgage, there's no opportunity to get out of a reverse mortgage, and that is not the case at all. It's exactly like a regular other mortgage, like Shannon mentioned, from RBC or from Scotia, whatever the case may be. That being said, clients right now who are struggling and have variable mortgages or HELOCs that keep increasing, and payments have gone from $3 to $5 to $6 to $700, this may be an option for them to even, explain to a client, what if I were to, introduce you to a product that could alleviate this stress from you for the next 3 years or 5 years? Would that be something that you would consider? Just even as a temporary solution for them, to understand that there is something that could help them with cash flow or whatever the case may be for a time period. It doesn't have to be permanent. And I think we're fixated in, once you're in, you can't get out, which is not the case.
That was the thought. I thought that you got to a certain place in your life where, out of desperation or whatever it is, you got into a reverse mortgage, and then that was it. You're going to die in that mortgage. So this is
definitely not.
Yeah.
And I'm glad you brought that up, Susie, because I was going to go into some of the products, but it also a perfect opportunity. Maybe we could bring up some examples with our own clients that we've actually used it for. So just going into that, like Home Equity Bank has an open solution, an open mortgage product. And that could be for somebody who, you know, they just need a temporary fix or it's a temporary solution. So they keep an open term. And then you can also go on a 1, 3, or 5-year term as well. And so for one example, I remember I do have a lot of realtors who are actually on this product. And one of the reasons would be is because they're commission based like us as mortgage advisors or financial advisors. And so depending on how busy they are, they don't always have that commission coming in. They might not be able to budget properly. So one of my realtors, he actually got sick. He wasn't able to go out and show homes or anything anymore. He thought he had absolutely no options because he had no income to go to the bank and qualify for a mortgage. So we took a look at his overall situation, and we thought this was the best solution for him, because at that point in time when we took the mortgage, he had a date when he would be able to go back out from work from his doctor, and he said, okay, we're going to take it for X amount of time. We consolidated all of his bills, paid out all of his debt, and put him into this mortgage for 1 year. Another realtor, similar situation, but however, when she closes a transaction, she takes a lump sum each year and just pays down on her mortgage. So it's just to show that everybody has a different reason for going into a reverse mortgage. Another client I had, older lady, no longer working. She only receives pension. Her children had not enough income coming in. And let's be honest, she did not want them on the property. Even though they met the age criteria, she did not want them on the property. So she decided to go into this herself. She had all of these ideas of, oh, I'm not going to own my home, blah, blah, blah. But, she sat down with her accountant. She sat down with her children, and then she sat down with me. And then she realized, okay, this is the right product. It's actually being explained to me properly. Let's move forward. So those are 3 examples of actual real life clients that I've worked with for this product.
Yeah,
Okay,
I have
but-
some, go ahead.
Oh, go ahead,
A
Catherine.
question. Susie was saying that, okay, you don't have to stay in it, and you were mentioning, Shannon, the person used it just for a short period, but do they come back out of it with their regular bank when they're done then? So you said he paid off bills and all that, but he's obviously carrying a mortgage.
Yeah, so in the realtor's case, yes, he did come back out of the reverse mortgage, because based on his commissions that he brought in annually, it then qualified him to go back into a conventional bank
Gotcha.
and obtain the mortgage at that time.
Yeah, I was just going to give another example of how it can be used in a short-term way as well. So I had some elderly clients that were living in the house that they had lived in for 50 plus years, and it was really hard for them to let go of, because they had watched their children grow up there, their grandchildren, but the house was also over 2,000 square feet, and at 75, that's a lot of square footage. I mean, my house is 950 and I have enough trouble keeping that dusting up to date, right? So now imagine mobility issues on top of that. So what we did was we took money out because their house had so much value, because they actually built that house way back. So we had enough to take out in cash to not only purchase a new condo for them, so that they could downsize and have a much easier time. But we also had enough extra that they could then renovate the condo before they even moved in, so that the condo was ready for them for all mobility issues. And then when the house was sold, the mortgage was paid off. And because of the no payments part, they didn't even have to worry about making payments on the money they had taken out. And they still had plenty of equity left over too.
Awesome.
Okay, question.
Okay.
If they had wanted to stay in their home and maybe make a secondary income property, could they have used it for that as well?
Yes, actually, that's where I wanted to go. So I think people
Okay.
It's only, this is, reverse mortgage is only to save, it's a savior mechanism. It's not. It can actually enhance somebody's retirement portfolio. So for those who are looking for a secondary home or even a vacation property, so with Home Equity Bank, you can actually blanket up to 3 properties. So imagine being able to utilize your owner-occupied home, take out some funds to purchase a investment home, being able to still reap the benefits of that income coming in. However, the choice is yours if not making any payments on both properties or all 3. And keeping in mind that you don't need to be mortgage free in order to be able to qualify for this product. If there's a mortgage outstanding, we'll pay it out if the funds are there. So yeah, it's just, there are so many opportunities. We also have clients who decide they want to withdraw some funds for investment purposes. It depends on what the client wants with their funds. It's their home, the equity is theirs, and so they decide what they want to do with it.
And Susie, one of my favorite that I want to add to that is what I call the gift of love. And that is, taking equity out of your home, leaving an early inheritance for your children, grandchildren, helping them with tuition fees maybe, or even helping them to buy their own home. And I've had a client who did that. They wanted to stay in their home, but they also wanted to help their child, their eldest child, because that was their promise. And, she wanted to keep her word. So we did a home equity, reverse mortgage, and we renovated the whole home from top to bottom, made it more mobility friendly, and also purchased a home for her daughter and her children. So I know we touched on like a lot of other opportunities that it was used for, but I wanted to bring that one up. Chris, did you have any examples with your client you wanted to share?
Very few. The ones that I have had the ability to participate in, like I sat in them, and it's the same consensus. Like they need income to bridge the gaps into other areas. So yeah, I had like the one I sat in. She needed the product to make her house more accessible, and it was a large house as well too. And she didn't want to move out. She wanted to keep her independence, but she needed the funds from her home to make it more accessible. So that was one of the things. But the one thing I do like about this product, every time a client does come in, they're already educated about mortgages because they went through a couple, refinances as well, and they understand the importance of handing in documents and stuff like that. And my brokerage, what I like about ours is that we have a lawyer on site just to make sure everything's explained from top to bottom and stuff like that. So we have pros and cons of what it's like to get into this product. Obviously, there's more pros than cons because there's more education surrounding it as well too. So at the end of the day, we try to tell our clients, this is not something to dig you deeper. It's something to put a bridge into your goals. So if you want to help your, kids buy a home, make your house more accessible, or you have bills that you want to pay off or properties that you need to attend to, this is a great product for you at this time.
Awesome. So just before we maybe open the floor for some questions, I just wanted to point out that Home Equity Bank, I believe, Susie, you can correct me if I'm wrong, you guys have been around for a very, very long time. I believe it was from the 1980s, right?
37 years, yes.
30, okay.
37.
See,
yes.
I was wrong. But it's still a long time.
It is.
And
yes.
Home Equity Bank there are a couple other banks out there that do reverse mortgages as well, but Home Equity Bank is one of the #1 providers in the industry that provides this product. And I've always worked closely with them for my clients for this particular product. And when your client is taking a mortgage, just like any conventional mortgage, they are required to seek independent legal advice as well. And Home Equity Bank is a federally regulated bank. So you're not dealing with a fly-by-night standalone bank or anything like that. Okay. Did anybody have any questions?
You have to be 55 or older.
Yes.
Okay.
Yes.
Just want to verify.
55 and a homeowner. So those are like one of the
That's
two.
true. Yes.
Yeah, no, sorry. One of the two minimum things we have to look for when this product comes across our table and we have to use it is you have to be at least 55 and you have to have a home under your belt to qualify.
Okay, so why? Why do you have to be over 55? What is it about this product that you need to be over 55? Does anybody know?
So you have to understand how the product works at its core. Okay, so when we talk about mortgages, everybody thinks about your regular conventional mortgage. I have a principal and interest payment, and with each and every payment, my balance is coming down. So when you have a reverse mortgage, the opposite is happening. And like we said earlier, there are options to make payments, but a lot of times maybe that doesn't make sense for a client. So what's happening is the interest will be growing. So because of how that reverse mortgage is going to accrue a balance, we want to make sure somebody's not going to lose their house over this, because that's not the end goal, right? So we don't want someone to get into a position where all of a sudden the interest has accrued and there's not enough time for them to get the equity back, right? So that's why I say, like, we have to understand it at its core and how it works different from a normal mortgage.
And home equity bank, they actually have a guarantee that you never owe more than what the value is of the property. Did I say that right, guys? I think I said that right, Susie?
Yes, yeah,
Okay.
we assume the liability, basically, yeah.
Yeah.
Sorry, can you say that again? You guarantee?
If there's a negative liability, like if God forbid, if something were to happen and the client actually owes more than the home is
Can you
worth,
hear me?
we
Yeah.
would assume that.
Okay, gotcha. I would still have my house, but never owe more than 45% of that money.
Well, the max that we can lend anyways is 55% loan to value, right? So you're not really putting someone in a situation that we would deplete their entire equity. And let's be honest, guys, 55 years old nowadays, that's pretty young, and I'm sticking to it. So
Yeah,
yeah, that's pretty young. So you're not going to get 55% loan to value at the age of 55. It's all relevant. We do have a calculator online. We take into consideration, as Shannon mentioned prior, the client's age, where the property is, what type of property it is, and the value of it. And that generates a calculation, an amount that it's allotted for the client. And that amount takes everything into consideration. Yes, are you going to get a different loan to value, someone who's 55 to someone who's 80? Absolutely. Different life stages. We're not going to put someone who's 55 in the same type of life stage as opposed to someone who's 80. We do take that into consideration, and things change at the age of 55. People decide they want to move. People decide this is not for them. So we are very conscious of the way we lend and the way what we do with the clients. We make sure that security is there for both. Does that make sense, Catherine?
And Catherine, if I can also add to, with your property value, we only so even if you were to take a mortgage from home equity bank, and let's just say we go with 50%, right? And that's what you receive. Your value is only going to go up over time. Whereas, like, even right now in today's market where people are refinancing or even purchasing and the value is coming in underneath what they're actually purchasing for or refinancing, there is more than likely there is still going to be equity there because you are only borrowing up to 55% of the value of your home. So even if you were to run into a case like that, with a reverse mortgage, you have that guarantee. But like Susie says, majority of the time, your equity is never depleted anyways.
Sorry, it's 55% of the value of the home or the equity in the home?
The value of the home.
Fascinating. Okay.
Any other questions, guys?
Okay, so as things change, my value of my home 10 years ago compared to my value of my home today is quite different. And I only know traditional banks, they're right. If I was looking for a mortgage time, they would do an evaluation. Does that ever happen with reverse mortgages, that they'll go, oh, well, now your house is worth, you know, it was 300,000, but now it's 700,000, and then I could borrow more? Oh, okay.
You're absolutely right, Catherine. Yeah, you can refinance with us. And as you age, the allotment and the loan to value increases as well. And what we do have, Alessandra, I'm sure you've used and Shannon, the financial calculator, the illustration. So when we do a calculator, you can also show your client. We have a financial illustration, 10 years, 15 years, 20 years, and show them. This is all the interest that you're going to pay within 10 years. However, at a modest 3 or 4% growth, this is how much more equity you could still have available to you after 10 years. Yeah. Sorry, Shannon, go ahead.
Oh, I can't answer your question because I didn't hear what you said.
Okay.
So if Alex heard, I only heard Alex's name. So if you heard Alex, please go ahead and answer.
I think we were mostly talking about the financial calculator and how it shows the difference of, yes, the interest is going to grow, but also the equity still grows as well.
Yeah, it's good to hear this because, again, I'm not in that position, but it gives you a lot of thought, because that's what my husband and I we've got multiple properties, right? And we made sure that when we bought the property we're in, it's an income property, so that our lifestyle won't change. Right now at 57 and 59, but who knows at 65 and 63, right? So it's good to have these in the back of the mind, honestly. Thank you.
I think another important thing to maybe discuss is the difference between somebody taking a private mortgage over this, because I've had clients in that situation before, and I know from myself, a private mortgage, it's way more expensive than actually getting yourself into a reverse mortgage. A couple of reasons for that could be because of the what we call a lender fee. So that's how much the individual or the private bank would want to charge the client. And then depending on the loan amount, I believe, anything over 75,000 on a private mortgage, you have to have 2 lawyers. So I like to estimate my legal cost at about approximately $2,000 each. So then you'd be looking at, whereas if you go with a reverse mortgage, the legal cost would be a lot lower. And then when it comes to refinancing out of that private mortgage, what you might be in a case where the client cannot refinance back into a conventional mortgage, depending on why they ended up in that situation in the first place. And then upon renewal, they are going to have to pay the private lender a renewal fee again. It could be anywhere from $2,000 or it could be $10,000. We never know until we actually look at the commitment and read the terms and conditions of it. And lastly, if you're working with a private lender that does not want to prepay the mortgage or include the payments into the mortgage for the client, then we put a strain. We're back to square one, basically putting a strain on. They cannot afford to make these payments. So it was kind of like, what was the purpose then of doing this? So I think the reverse mortgage has quite a bit advantages over the private mortgage, depending on your client's needs.
Yeah, and I'm going to agree with that. Private mortgages, they have their purpose, just like any other type of mortgage in what we do. But like Shannon said, there's a lot of fees, there's a lot of expenses, and oftentimes private lenders will also take over paying property taxes, and then they charge another fee for that because they have to have an administration fee that covers that cost, right? And like Shannon said, the exit strategy is so important. Yes, you could get a private mortgage, but it takes a lot of planning to get out of it. And if we're dealing with somebody who already has trouble qualifying for a regular mortgage, like Shannon said, how did we help you at the end of the day? Like, how is that the best solution for someone when we already know there's a qualification issue here?
Can I ask, because I remember you talking about how the different mortgages rate when you're paying down, but the other one you're not. So with interest payment, interest rates, is it because you're a federal bank? Is it like prime plus whatever? Like how are your interest rates on a reverse mortgage?
So really quick, so when you hear prime plus, that's usually for a variable mortgage, right? So there's always fixed and variable options for things. So in terms of what the actual, like, are you asking how they're calculated basically?
No, but like how do they,
Or the
like,
different rates.
Are the numbers close to like a traditional bank, like a RBC or like an A lender, right?
Yeah, so they're not going to be the same rates that you see with like TD, RBC, CIBC. You're not going to see that same kind of thing because it's a different type of mortgage. So with mortgages, sometimes the interest rate tells us, you know, what's happening with that mortgage. Because if you can qualify with a letter and a pay stub and a T4, and there's little to no risk, the lender says, great, best rates that are available. But sometimes when we have situations where the clients qualify in a different way, that interest rate might be higher because it's a different type of risk that the lender's taking on. So when it comes to a reverse mortgage, the risk, we know these clients are either not going to make a payment or they make some sort of payment, right? So the interest rate is going to be higher because it's a different kind. And they're really looking at, you know, we're mostly lending on the property, not necessarily the person. Because if somebody's not making payments, we're not worried about them not making payments.
Right. Okay. And you said that in a traditional mortgage that I would have while I'm still working, it's a daily calculation of interest, right?
For the line of credit, the home equity line.
Oh, okay. Sorry.
Yeah.
So what is different with a reverse mortgage then?
I believe it's still calculated is it monthly or semi-annually?
Semi-annually.
Semi-annually, so twice a year.
Yes.
Twice. Okay. I knew it wasn't daily, but I couldn't remember. Thank you.
So, okay, so I have a question, right? I mean, this just sounds so good. I mean, why doesn't everybody take out, you know, something to invest or whatever? What's the downside to a reverse mortgage? What's the risk, would you say? Okay.
Things that is required, right? So you're in breach of.
Again, can you repeat that again? You cut out for a second.
Yeah, so when we think back to what we said earlier, there are certain conditions that you need to do to keep your mortgage in good standing, right? So if you're not going to keep your property taxes up to date or your condo fees, then you're in breach of that contract. That was your part to play in this contract.
And therefore, the end result of that loss of property.
Or your house in good standing as well, like,
yeah,
like completely disintegrating, right?
Right.
Just, like any other mortgage company, same thing. There's rules you need to adhere to.
So if your history has been good and you're on time with everything, what is the risk? Like, I die, what happens? Like, is everything just the same as a regular mortgage? I die, everything gets passed on to my, you know.
So that kind of comes down to your estate planning, right? So if you're the only one on title and you pass away, then your estate deals with it. But if you're on title and it's you and Teresa on title, if Teresa's still there, then you can still continue on, because I believe, and correct me if I'm wrong, I believe it's when the last borrower either passes away or goes into long-term care or somehow moves out of the property.
Yeah.
That's actually, thanks, Alexandra, for mentioning that. I know that sometimes there's also, you know, someone will say, you know, my husband's only on title or my wife is only on title, but both of them live in the property. We take both into consideration, even though one is on title, for that purpose itself. Is like, what do you do if someone passes away? You don't kick the other person out, right? So yeah, it's status quo. We take, whether there's only one person on title, we still take, you know, both into consideration, because it is a matrimonial home and legally it does belong to both. So we want to make sure that we're benefiting both. So it is last surviving. So we would only request our funds when there was no one else living in that home. basically, like whoever is on the mortgage.
But you do have time constraints once that's happened, whether passing or moving out.
We normally
Quite liberal.
sometimes it could be 6 months. It depends on how long it takes to sell that home. You know, times are different right now. So of course, we'll work with the client. Absolutely.
And I'm not sure if this was said, but if the home's not sold, then the children would have to qualify for the amount of mortgage that is on the property if they do want to take it over.
Now, see, that was
That's
something
perfect. Yeah.
I was never told, because my mom's home was a property income, and we were told that when she moved out, we had that, you know, to decide what we were selling or what. And yeah, was that we would have to get a traditional mortgage to
Yes.
block that out.
Pay it out. Yeah.
Yes, yeah. So you would have to
Okay.
qualify for traditional mortgage to take it over.
Oh, true. Okay.
So Ivan, I think more going towards your question is, if you were 55, let's say you had a house worth $500,000 and you got $100,000 loan at 55, let's say you die at 80, you're going to have 25 years that you've paid X percent at, right? Just for the sake of throwing a number out there, let's say it's 250 now, okay? Because 25 years probably doubled it and then some. So when you die, your estate is left with a $500,000 house as a $250,000 loan, which you're going to have to pay, your estate's going to have to pay off. Then you're going to have 250 left for your estate. Okay, that's the bottom line. Now, if you took that same loan when you were 70 years old, took $100,000 out, now you've got just under half the amount of time. So maybe now your loan's 175 instead of 100. So you're going to have a little bit more for your estate, but you're going to have to pay that 175 off. Your estate will have to pay that off to the loan. And so that's your downside, is if you take it too young, obviously there's going to be more interest, so the balance is going to be bigger that you will, right? That's just like if you don't pay your mortgage off and you keep dragging it out. If you pay your mortgage off in 20 years, well, you pay X number of dollars. If you take 40 years to pay off your mortgage, well, you're paying more interest, right? But that's with every loan, right? So you have to look at what's the interest rate, what's the benefit. Alexandra and I actually talked about this last night. Personally, myself, I wouldn't recommend this for someone who's 55, just because there's that big time factor. But somebody who's like 75 or 80 years old, and they know they've only got a few years left and they want to stay in that house and they're a little bit short on income, absolutely, like, you're allowed to stay in your house. Yes, there's going to be a little bit less for your surviving family members, but guess what? You get to stay in your house to the end. And so, and Alexandra said this, she says, the solution's not right for everybody, but there are cases where, you know what, it makes a lot of sense. And it's like every other thing that's available out there. Sometimes something's right for you and sometimes it's not. So you got to weigh the benefits versus the costs at the end of the day for anything. Doesn't matter what it is.
Yeah.
And, you know, so those different solutions can make a lot of sense sometimes. Sometimes they might not make as much sense. Because, yeah, I mean, there's an assumption that real estate always goes up. And in Ontario, it does. But I know places where real estate doesn't necessarily always go up. It actually has fallen in value over time. And that's due to, you know, local economic factors. So yeah, I have friends in Pittsburgh. They bought their kids' houses because when the steel industry died in Pittsburgh, real estate crashed. The expensive house they bought for their kids was $29,000. And those are houses that at one time were worth over 100,000. So, you know, you have to look at all the factors.
Well, I'll just say that my mom was, I'm sure, close to 80, and so my brother, I don't know, 20 years younger, right? Living together, and it was good for them because they had an aging house, right? It was a house my mom had got married and moved into like 3 months later in 1950 something, and she was not moving and until she didn't know she was moving. So it allowed them to make the repairs, yeah, because her new windows were a new kitchen from the 70s, like, you know, they needed some repairs, so it kept the house at least warm and accessible for them.
Yep. And I think, Catherine, that's like a classic case, somebody who's, you know, been retired for a number of years, the income's falling short, you know, that you're not going to be there another 20, 30 years, right?
Yeah.
And it fits a bill perfectly.
Mhm.
Does a great job for that.
Yeah, I think they had it for 3 or 4 years before everybody's health started to decline, but it served them well while they needed it. So
And the other part of that too is when you're up in those upper ages, 70, 75, 80, you may not qualify for any kind of a loan at the bank.
Nope.
They say, you know what, you're old, your income's low. We don't want the hassles when you pass away, so we're not going to loan you anything.
Yeah.
And you know, that's where especially as you age, where this becomes more of a better solution.
When you don't have a T4, nobody wants to talk to you about money.
Yep, exactly.
So I am finding.
But, sorry, were you saying something else, Catherine?
No, thank you, because it was a good discussion, and
Absolutely.
and I think people, once they hit 50, should all be included in this discussion, or at least start getting educated about it. So it's just part of your financial knowledge, right? Like
or your financial plan for the future, right?
knowing that it's a possibility, so I can come to you and go, is this an option? Right? Like we typically do for, you know, okay, I need to make a repair because this and this and the insurance isn't covering it. What are my options? Like having that knowledge, I think is valuable.
Absolutely, Catherine. And Chris, you know, I always think about all those people that have gotten disinformation about reverse mortgages and end up leaving their home because they don't think they have a choice, right? Where we're just, you know, somebody just sit down and say, no, it's not like that. We're not trying to rob you of your house cleverly, you know. So yeah.
You do have to have equity though, right? If you buy your house when you're 65 and then you want to do this when you're 70, like you're not going to have a lot of equity. So then it's not a solution, right? But if you have equity, and I mean, let's face it, with, you know, anyone who bought a house even 10 years ago, because of the rapid rise of real estate prices, you now have a lot of equity, even if you still have a big mortgage. Because, you know, that $350,000 house is now $700,000. And if your mortgage was $200,000, well, yeah, you got $500,000 of equity, right?
Right. Yeah.
At the end of the day, sorry, like these clients, they want to keep their independence. They want to, you know, continue their daily lifestyle they have developed all over these years, right? So this product helps them do that and helps them keep their household intact, or, you know, further the like financial goals that they have. So in the limited time I've seen of this product, the one things I like about it is that I get more discussion from clients that are interested, because they have a lot more questions, a lot more concerns. So it's a lot easier for the brokerage, if they're equipped, to narrow in on the needs that they need, so that this product helps them a lot better in the long run, right? So that's what I've noticed so far, is that it furthers their independence and helps them accomplish what they need to at that point in their life.
So the last thing I wanted to say, even though I have a not off topic ask at the end, is our process as mortgage professionals, like myself, Alex, Chris, there is a process that we go through. Sit down as a client, you sit down with us so we can advise you, find out your needs. You go back, talk to your family, then we do an application, order a home appraisal so you know the true value of your property. And once we get that approval for you, you seek your independent legal advice, and then you enjoy your money and your life, depending what you're taking out. I want to say thank you for everyone who joined us on the call or offline, just listening. I think it was a great conversation, and thank you, Susie, for joining us today and adding a lot more value to the conversation around reverse mortgages.
Yeah, thank you very, very much, man. I'm telling you, I'm calling my mother. All right, everybody. Thank you. Have a
Bye-bye.
great. Take care. Thank you.
Okay.
Thanks,
Have
everyone.
a good day, guys. Bye.